This is a follow-up episode on the Bitcoin flash crash episode. It's still April 20th. Quick update, the market was still open. On the first episode, it's still open now. We are now down about 2% for the year, and the market is up about 9.2%, so we're underperforming by 11.2%. I just want to follow up. The market's still open. These numbers could change, and for those people who are annoyed by this, this is just the way I'd like to do this podcast. I think I just want to really drill down that performance is the key why we actually exist. So performance is everything. So all the talk, everything we talk about here, all boils down to performance. That's why we give an update every time when we start a new episode in this podcast. Let's talk about leverage. I spoke about leverage as part of the reason, probably the main reason why the crypto market sometimes has these crashes, like on Saturday, April 18th. And I just want to drill down a little bit more on leverage, because we use that word in many ways in different markets. By the way, in some markets it's called mortgage, in others it's called leverage, in others it's called hedge fund, exposure. These things have different meanings, but they all end up being the same thing, which means that you put a certain amount of equity into an investment, and then you borrow money to leverage your investment. That's where the word leverage comes from. So the most famous market that a lot of Americans are familiar with is the mortgage market. Mortgage is nothing but leverage. And it's, for most people, by far the highest leverage that they will ever have in life. Because the mortgage market is the only market I know where you can put more than 5, 6, sometimes 10 times leverage, and most of the time not even go bust. This is the amazing thing. Why? Well, because the mortgage market, of course, it's your home, so it's protected by the government. And to some extent, all the other investments that we know about, the Wall Street, the traditional investments, the bond market, stock markets, they're kind of the same in the sense that the government is protecting them. In the stock market, it's through the Federal Reserve. In the bond market, the government is protecting the bond market because a lot of people are investing in the bond market, but also the government actually needs the bond market to lever themselves. So there's this implicit incentive to keep the bond market alive. I think I want to talk about leverage in two dimensions. I would say there's leverage that you need to actually even get involved in a particular investment, and then there's leverage where you just do it because you want to enhance your return. So let's talk about the first one, which is the one that, let's say, applies to most people in the mortgage market. You just can't buy a house because you don't have the money. So the government enables the leverage. It does tax-deductible mortgage rates and things like that. So what they want is people to own their home, and you can't buy a home, so you need to use debt or mortgage. The same applies to a company. It needs to build a factory, or you start a restaurant, you need to build inventory. Whatever you do, most of the time entrepreneurs, they need capital, and capital is usually raised through either equity or debt. There's the famous Miller-Modigliani theorem that says it actually even doesn't matter if you use equity or debt. I don't want to go down that route now. This is very theoretical. But my point is that, in fact, it doesn't really matter how you finance something. The point is you need some sort of financing, and you can do it with debt or with equity. If you do it with debt, then what we will call with leverage. The other part of the leverage coin is the one where you just do it to enhance your investment. So let's say you could buy stocks, you could buy bonds, you could buy crypto, but you want to get much more exposure because you have this bullish view, or vice versa, a negative view, and you want to short a lot more than you actually have capital to short. And therefore, you would use leverage again to increase your position. And this is the second part, I think, is what's happening currently in the crypto market. There's a lot of people who are getting exposure to crypto, a lot more than they can actually afford, and that's leverage. And the DeFi world is actually offering a lot of leverage opportunities. Some of the crypto investors even say it, like, we see a good first product market fit with crypto in terms of the casino. So they're offering people gambling opportunities, which is just a bit of a harsh word to you to say the same thing. If you buy, let's say, if you want to buy $10,000 worth of Bitcoin, but you only have $2,000 and you can lever 5 times, so you can buy $10,000, but you only put $2,000 down, that's gambling. Why? If Bitcoin goes from $10,000 to $9,000, you lost $1,000, which is half your equity. If Bitcoin goes from $10,000 to $8,000, you lost all your equity and you will be forced liquidated. That means that the exchange will sell the other 8,000 and therefore be a wash, meaning they took your 2, they sold the 8, so they have no loss and you lost all your equity. There's one exchange that I follow, DYDX. They offer up to 25 times leverage. That means you can put down $100,000 and buy 2.5 million worth of Bitcoin. Of course, imagine if Bitcoin goes down by 10%, you're finished. So this is in a nutshell what's happening. I'm not here to judge anybody. I'm not here to say this is good or bad. Venture capital is going into DeFi marketplaces that offer leverage, either through trading leverage, or there's also companies like Compound and Aave that offer you can lend or borrow against your crypto, which is another way of leverage. What that means is I buy $100,000 worth of Bitcoin. I then go and borrow $50,000 US dollars against my $100,000. I take the $50,000, I use them for my expenses. So I still have $100,000 worth of Bitcoin exposure, but now I owe 50,000 US dollars. And that's obviously, I can't do 25 times leverage with these types of collateral loan exchanges. The leverage, I think, can go up to 50%. By the way, in the equity market, for example, our prime broker allows us 50% leverage, so we can put maximum about 50% of our NAV against to use as loans, which is, that is what it is. Again, I'm not judging. I don't have insight into risk management models and how much leverage is right or wrong from an exchange perspective. I can tell you from our perspective as investors, let's say we are on the fund level roughly 12% leverage right now. So, and we really want to operate below 25% leverage, at least for now. There are maybe times when we could increase that leverage or should increase. I think we're pro-cyclical, unfortunately, right now, and it's very difficult to be anti-cyclical in a bull market. But we see so many innovative trends that are so amazing, particularly the blockchain technology, but also intelligent electric cars and CRISPR. We just feel that it would be, given the upside, we don't think that it's prudent to wait for a better entry point and lower our leverage down and increase it. So we don't want to do that. Some hedge funds do that. I think that you also, in order to do that, in order to time your leverage, in order to time when you go bigger and smaller in terms of leverage, I think you need technology and know-how how to do that. In my view, that is possible. There are certainly hedge funds that can do that. The question then is, can you do it consistently? Sometimes you get lucky, but if you can do it consistently, then that's, of course, actually an additional trading income for you, meaning you can then, size up when markets correct and size down when they are frothy. The problem with that is if you have assets that trend higher, that have just like endogenous growth of 20, 30, 40%, it's really futile to try to time these things because you will miss the endogenous growth. And that is the dangerous part of doing this in and out strategy. So we at Orange Capital Partners, we're not in and out type investors. I've said that many times. We don't time things. We have a certain thesis which is built on our principal stack, and then we stick with it. And again, we don't want to be higher than 25% leverage. This is our goal, which means that at any point in time, we have to be between 10 and 15% leverage. So let me give you a numerical example to illustrate that. Let's say you have $100 of NAV. You put $15 of leverage. So your NAV now is your asset value is 115. You borrowed $15. Let's say you have a 30% drawdown. So now you're at, let's say, something like 75. So the $15 of debt against the 75 is roughly almost 20%. So you can therefore, with a 15% lever ratio, probably stomach something like 45% drawdown. and then you get to the 25% leverage when you in our case, we would start selling some funds. So this is the tricky part, and this is also the dangerous part, because you don't want to be caught. It's very difficult to be not a liquidity user instead of a liquidity provider, meaning when it's really the worst, you have to be a seller. You don't want to be in that position. But I just wanted to illustrate that numerical example. This is how we think at Orange Capital Partners. So to get back to the general conversation of leverage, so here's again, we have the biggest levered market in the world is the US mortgage market. And we've seen over the last decade how bad this can go. And we had all these bailouts and the trillions of dollars of bailouts that the Fed had to pay to keep housing prices high in the US. We believe it's terrible. It's terrible for many things. It's terrible for, it also adds to the income inequality and the wealth inequality of the country, because for many people, they can't own a house, but the house prices keep going up, so they are not participating in this. And then even the people that are participating, for most people, they are barely able to survive. And the problem is, let's say you own a home, you bought it for $1 million, it goes up to $2 million, great. But you can't really cash out. On top of that, your taxes are going up, your maintenance are going up, your neighbors are, your neighborhood is more expensive, everything is more expensive, it's inflation. You don't really see the upside. I mean, yeah, on paper you're worth something, and maybe you're going to do a home equity loan, but then God forbid, if there's a correction in the market, then you might lose your home. So it really doesn't help. It creates enormous amounts of distortion in the behavior of people. And again, we're not judging. It's fine if that's how politics, if that's how a country wants to be run, then that's fine. You want to have leverage on the mortgage market, because what it does, and this is now a little bit, let's say, political, but what it also does, it obviously enslaves people to their jobs, their employment, and gives employers a lot more power over employees, and that creates a lot of stress and I think a lot of anxiety within people, because imagine you have, let's say, a $2 million home and your income is $200,000, so after tax you have maybe $130,000 left, and you have to maintain that home. You have to also, the vanity kicks in, your neighbors have a nice porch, you want to have a nice porch, all these things cost money. The higher the real estate prices, the more you're going to spend. So you're just a slave of your own real estate, and that's, in our view, very bad. This is also why people like Elon Musk said they don't want to own some. We are in the same field, like no matter how much capital we have, we always prefer not to own real estate. We want to just rent. The problem with that is the rental market is not that liquid, so it's relatively difficult to find very nice places to live in as rentals. But anyway, that's besides the point. So to summarize, the mortgage market is the highest levered market, and it's being supported by the Fed. We believe that also the stock market and the bond market in the end are being supported by the Fed because of leverage. Leverage is always the reason for bad actions. And we believe that there's a good chance that you could see the same thing in the crypto market. If the crypto market becomes big enough and the leverage keeps going up, that you could have a situation where the Fed has to bail out even the crypto market. We're not there yet, like I said in the first part of today's episodes, but I just want to point this out as a thought and also as a discussion topic for further discussions of how leverage will impact the crypto markets, of how DeFi should self-regulate itself, how maybe we could use the smart contract technology of, let's say, Ethereum to make sure that the leverage doesn't go overboard. This would be an interesting thought process, maybe a project, maybe an academic project, or even an entrepreneurial project to build a DeFi exchange that has implicit controls, algorithmic controls over leverage, so that leverage cannot become a self-fulfilling prophecy that eventually brings down the exchange and maybe also creates a lot of havoc with the particular cryptocurrencies that are involved. Thank you.